Good morning and welcome to TOITOI Japan Market Radio for January 16, 2026. I'm your host coming to you from Tokyo with the daily briefing designed for global investors tracking Japan's markets. Today we're seeing mixed moves across Japanese assets as currency dynamics take center stage alongside regional geopolitical developments. Let me bring in our portfolio manager to walk us through the numbers.
Thanks for having me. Looking at the broader market picture today, Japanese equities closed with modest losses in the major indices. The Nikkei 225 finished at 53,936.172, down 0.322%, while the TOPIX declined 0.156% to close at 3848.0. More encouraging was performance in growth and alternative segments, with the Mothers Index advancing 0.746% to 2,295.0 and the JPY Index gaining 0.625% to reach 2092.5. On the currency front, dollar-yen traded at 158.114, down 0.182%, reflecting some yen strength that's been the key story of the session. Commodities showed divergence, with gold in yen terms at 17390.0, down just 0.086%, while crude oil rallied 1.132% to 59.86.
That yen move is particularly interesting given it comes against a backdrop of rising intervention chatter. Reuters is reporting this afternoon that Japan is actively considering coordinated currency intervention with the United States to counter yen weakness. This is a significant potential shift in policy coordination between Tokyo and Washington. Walk us through what this development means for Japanese markets.
This is indeed the headline driving sentiment today. What we're seeing is a signal that Japanese authorities, likely the Ministry of Finance in coordination with the Bank of Japan, are exploring joint action with U.S. counterparts to manage exchange rate volatility. The key point here is that this suggests policymakers view recent yen weakness as problematic, moving beyond benign tolerance into active concern. For context, excessive yen depreciation has been a double-edged sword. It benefits exporters through pricing competitiveness but simultaneously imports inflation through higher commodity and input costs, which pressures household purchasing power and creates political tension.
So this is really about drawing a line in the sand on how weak the yen can get before it becomes counterproductive. What does coordinated intervention specifically imply for the three main asset classes our audience monitors?
Let's break it down systematically. For Japanese equities, the impact is genuinely mixed in the near term. Export-oriented sectors like autos and electronics have benefited substantially from yen weakness, so a sustained yen strengthening would create earnings headwinds for those names. However, the broader market may actually welcome this because it signals policy clarity and reduces the extreme FX volatility that makes corporate planning and cross-border investment decisions difficult. On the currency itself, we're already seeing upward pressure on the yen, and if formal intervention is announced with specific parameters, we should expect further appreciation. That benefits yen-denominated returns for domestic investors but pressures export earnings as I mentioned. For JGB yields, the picture is nuanced. Coordinated intervention typically signals reduced deflation concerns and active policy coordination, which could push yields modestly higher. But at the same time, a stronger yen historically attracts safe haven flows into Japanese government bonds, which supports demand and caps yield rises. The net effect will likely be stability with perhaps a slight upward bias.
The market will clearly be watching for any formal announcement from the Ministry of Finance or coordinated statements from the U.S. Treasury. Staying with the regional theme, we've also seen significant headlines around U.S.-Taiwan relations today that are moving Asian markets broadly. A new U.S.-Taiwan deal has been announced, and it's driving fairly broad-based gains across the region. How should Japan investors interpret this development?
This is fundamentally a geopolitical reassurance story for the region. While the specific details of the deal are still emerging, any strengthening of the U.S.-Taiwan relationship reinforces America's security commitment to Asia, which is critically important for Japan. Japan has its own territorial concerns and sits in close proximity to potential regional flashpoints, so reduced Taiwan Strait tensions lower tail risk across the board. There's also a very practical supply chain dimension here. Taiwan is the epicenter of global semiconductor production, and a stable US-Taiwan relationship supports predictable supply chains that Japanese tech companies and manufacturers depend upon heavily. This reduces operational uncertainty.
And presumably that translates into a risk-on environment for Japanese equities specifically.
Exactly right. For the Nikkei and TOPIX, this is a near-term positive. Risk-on sentiment lifts regional equities broadly, and it particularly benefits cyclical and export-oriented sectors like autos, semiconductors, and machinery that are core constituents of Japanese indices. On the currency side, increased risk appetite typically favors carried trades and risk assets, which creates weakening pressure on the yen. That supports exporters but may face some offsetting pressure if US rates rise in response to stronger growth expectations. For JGB yields, risk-on sentiment combined with potential dollar strength would create modest upward pressure on the long end, though the Bank of Japan's policy settings remain the dominant driver of the curve. Overall, this is a market-positive development that global investors should view as supportive for Japanese equities in the near term.
It's interesting because we have these two somewhat countervailing forces today: intervention talk that strengthens the yen, and regional risk-on dynamics that would typically weaken it. That might explain why dollar-yen is only down modestly today rather than seeing a sharper move.
That's a very astute observation. The cross-currents are exactly why we're seeing relatively contained moves in the currency despite quite significant headline developments. The market is essentially weighing official intervention risk against underlying risk appetite and regional stability improvements. This creates a tug-of-war that results in range-bound trading until one of these forces decisively wins out.
Shifting to the broader global context, we're also seeing world shares hovering near record highs despite what the headlines describe as simmering geopolitics. That seems somewhat paradoxical, but it's clearly relevant for how global investors are positioning in Japan. What's your read on this apparent contradiction?
It's a fascinating dynamic and it speaks to the resilience of risk appetite in current markets. What we're observing is that investors are maintaining equity exposure near record levels despite ongoing international tensions, which suggests they're either discounting the probability of escalation or they view current geopolitical risks as manageable and already priced in. For Japan specifically, this matters on several levels. Japanese equities benefit substantially when there's broad-based global equity strength because of the export-driven nature of the economy. Cyclical sectors that depend on international demand, like autos, electronics, and machinery, track global equity sentiment quite closely. So this risk-on environment is fundamentally supportive.
But presumably there's a tension here with safe haven dynamics as well.
Precisely. This is where it gets interesting for the yen and JGBs. Geopolitical tensions, even when they're described as merely simmering, can trigger safe haven flows into the yen, which would potentially offset some of the export competitiveness gains that come from equity strength. We're seeing a bit of that defensive yen demand today even as equities hold up. For Japanese government bonds, rising global yields that typically accompany equity strength near records create modest upward pressure on the 10-year JGB yield, but the Bank of Japan's policy settings act as a binding constraint on how much yields can actually rise. The key watch point for global investors is whether these geopolitical tensions shift from simmering to acute. A sharp risk-off event could rapidly reverse these dynamics and send flows flooding into yen and JGBs while Japanese equities would face pressure.
So in many ways, Japan remains caught between its role as a risk asset play through equities and a safe haven destination through currency and bonds.
That's exactly the duality that makes Japan such a nuanced market for global investors. You need to monitor both risk appetite globally and specific regional geopolitical developments simultaneously, because Japan's assets can respond quite differently depending on which force dominates. Today we're seeing that tension play out in real time with equities down modestly, the yen slightly stronger, and yields relatively stable.
Let's bring this together for our audience. What are the key themes global investors should be tracking as we move through the rest of this week?
3 main themes stand out. First, watch for any official announcements on coordinated currency intervention between Japan and the United States. The specific parameters and any formal statements from the U.S. Treasury will be critical for direction in dollar-yen and will have knock-on effects for export-oriented equities. Second, monitor developments in U.S.-Taiwan relations and broader regional geopolitics. The supply chain implications and risk sentiment effects are directly relevant for Japanese tech and manufacturing sectors. Third, keep an eye on whether global equities can sustain these record levels despite ongoing geopolitical uncertainties. If we see a shift from risk on to risk off, Japan's safe haven assets could see significant inflows while equities face pressure. The cross currents make this a particularly dynamic environment.
Excellent summary. For those of you tracking Japanese markets as part of your global portfolio, these are the key dynamics to monitor in the sessions ahead. As always, we're not providing specific investment advice or recommendations to buy or sell individual securities, but rather helping you understand the macro forces shaping Japanese asset prices. If you found today's briefing useful for your Japan investment process, please consider subscribing to TOITOI Japan Market Radio for daily updates. Thank you for listening, and we'll be back tomorrow with the next market briefing.
Thank you.